What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is October 18th of 2018. Well, folks, I hope you all are having a wonderful morning wherever you are across the world. It might be afternoon when you're catching up on the video. Today, we've got some really interesting things to talk about in regards to the daily update, both in crypto and traditional markets. As always, we'll be taking a good look at market valuations as well as doing some technical analysis on the market leaders. But outside of this as well, we've got some interesting things going on in crypto. We still have the massive premium between the variety of exchanges that people use to trade crypto and predominantly Bitfinex. So this $300 premium that's been really trending around is still going on. So I'm going to be spending some time to talk about what my strategy is and just kind of what I make of it. And a lot of that as well, we're going to be talking about traditional markets. Equities have made a tad bit of a rebound. So the question here is, do we go towards the traditional means of attacking equities markets where we BTFD or we buy the dip, or do we go about actually still looking for a few signs of strength before we make any assumptions that the market is going back to the bullish trend it has been in the past 10 years? So we've got lots of things to talk about. Let's not push it off any longer and dive right into the update. So I'm going to spend some time, of course, as always, taking a look, scanning across the 24-hour chart here on crypto. Ever since we've really made the rebound in markets with Bitcoin, mostly due to, I think, fears of Tether and the solvency of both Tether and Bitfinex across the board, we've seen that things are relatively neutral. Some players in the red, some into the green, but not too many in the range of double digits. So again, pretty neutral across the board. But things are getting a little bit more volatile. Some altcoins are making some moves. Some exchanges are listing new players. Ravencoin's been doing quite well. But again, things are still relatively neutral, or at least canceling one another out. As we can see here on the yearly chart, we've been able to hold quite nicely on market cap above 200 billion for the past few weeks. So it's good to see this. It's good to see that we're stabilizing. And again, this is not the time to get panicky or finicky, in my opinion, because we're starting to tell it. And you guys can just generally kind of see it. You grow a habit of looking at it once you become really a swing trader or a macro trader. And that is, you want to look for these periodic cycles where things on towards the sell side start to slow, and you start to see more of a sideways trend. As we've been talking about, we are in a sideways market. I know some people sometimes say, but Nick, Bitcoin just dropped $300 or $400, or this altcoin just dropped, or like Ether dropped, 5 or 6%. Generally speaking, though, in crypto, guys, the thing is these markets are volatile. As we can see in the past, crypto's made much bigger moves to the upside and to the downside as well. We're starting to see that volatility slow. In fact, I tweeted out the other day, and I don't want to ramble here too much, but I tweeted out the other day that there was more volatility on the S&P 500 with the recent sell-off than Bitcoin. Think about that. So we are getting into a period where Bitcoin is getting, I know, what might seem quite boring, but when things are boring, when things are quiet, we look for potential catalysts and we look towards players that provide an awesome discount. And again, that's going to have to be determined by you as a trader and investor, what really interests you. But going on here, I want to talk a little bit about market cap dominance because I think it's important here to really focus on. So as we take a look here, and actually I'll scroll down because I know my webcams can sometimes get in the way, but I want to spend some time to actually talk about what I'm generally seeing as a little bit of correlation here. I think what we're repeating right now in regards to Bitcoin dominance is something we saw right before we started the last altcoin cycle back in really the beginning of 2017, between February and March. That's when we started to see the depletion of valuations from January of 2017, and really started the major cycle going into 2017, which led towards a lot of the risk taking in crypto. As much as I don't want to sell that the altcoin cycle is coming, we have no proof of it just yet. We are seeing one sign within Bitcoin dominance, and I think it's a useful tool because we can sense when risk taking is starting to come into the market. So if dominance is a denomination of the kind of ownership of market cap within the cryptocurrency space, dedicated to certain cryptocurrencies. Whereas Bitcoin was holding it for quite some time, we not only saw in a longer term trend that Bitcoin dominance was depleting, but we also saw a pretty clear sign here when Bitcoin dominance was rising up, made a new short term high after going down to lower levels, and could not make a newer high as the price was starting, or excuse me, as dominance was starting to rise here. Again, a lower high than previously. And then after that, we saw a very sharp sell-off in regards to or not so much a sell-off, but a very sharp depletion in market dominance going into altcoins such as Ethereum. And again, when you have maybe a new altcoin come on the scene that catches investors' eyes and gets the market more excited, or some type of catalyst that encourages risk-taking, that could be showing in market dominance right here. It could be a catalyst, again, to bring markets higher, and Bitcoin, of course, higher, but altcoins at an even faster pace. So we have to look for those. We've talked about a lot of them. I won't repeat them, and I think I've rambled enough on the topic. But going on here to price action, there's not too much that I'm currently really looking for that we haven't talked about before. Bitcoin has been luckily holding a lot of the bounce that we saw the other day. And again, I'm looking at Coinbase here. This is much more of an actual rate of exchange like other exchanges, unlike Bitfinex, which has about the $300 premium. And we'll talk about that in a little bit as well. But at the moment, I'm looking for something very important. I'm looking for it to hold this support here on price. Again, what we saw back here and what we saw over here as well. And not only that, I want to get a pop up here, a really solid green candle getting above the 50 and the 100 day, as well as this line of resistance, which is currently holding down Bitcoin. But I want to see it with solid volume as well, because in this market, guys, again, we're still in a very bad paradigm where we're in a general kind of, I think what some people would say is a bear market, because things aren't really running up to the upside. We're not, obviously not in a bull market. And along with that as well, because everyone is trading on BitMEX and paper trading futures in regards to Bitcoin, we're not getting real volume on the exchanges. And that leaves a very big issue of potential manipulation. So, even if we get a pop-up, I want to see it with legitimate volume across all exchanges. And I'd like to see that premium on Bitfinex closed. And obviously the fact that it's been holding for so long shows that there's some genuine concerns. People are either dramatically moving out of Tether into Bitcoin, or there's some other thing that we don't know about. So Bitfinex has not done a very good job with PR in that regard. So going on here, let's go ahead and take a look at a few altcoins. Go ahead and take a look at Ethereum here. Ethereum still holding neutral after the dramatic sell-off we saw on October 11th. The pop-up really didn't do much in regards to its Bitcoin comparative, but it is holding above the lows over here. I think, again, the thing to watch for here is if this rolls over to the lows again, I think if you can get down to this range at, say, 3 million Satoshis, you're going to see it come down to about 2,700,000 Satoshis, revisiting those lows in a double bottom, forming a double bottom. I think that there's a good chance it could happen. But again, it's going sideways right now. I'm not going to try and play it until there's a real trade setup. If the price of Ethereum compared to Bitcoin comes up to 3,500,000 Satoshis, I think that's going to be a risk-on indicator. I think after filling this drop, you're going to probably see not only a move above the 50-day, but a big gap to fill between the 100-day moving average and getting above the 50-day. So not many serious resistance points until we test that level at the 100-day. So going to be keeping an eye on that. Going towards XRP as well. Ripple gotten back above the 200-day here. I don't know if there's really some big investors coming in here. Again, guys, I always want to be transparent on cryptocurrencies right now. A lot of the volume and price movement is dictated by market makers, okay? You got to realize that they're in this low volume market, there's a lot of manipulation tactics. But I will not play against the fact that currently, right now, it is above the 200-day. And if buyers are really coming in here at these levels across exchanges, this could be interesting here. If it can hold up here, I'd be interested in possibly seeing this continue higher. But really not 100% confident yet. We really need to see this hold up on this level for the next few days. And if it does, Ripple can make some serious moves. We don't want to doubt that. So especially if there's some more news coming out with XRapid in regards to adoption. So we'll keep an eye on this. I think, again, XRP is always a good momentum play. Going on here to Bitcoin Cash. Bitcoin Cash right back down, selling off any kind of gains that it had, coming back down to this level. I'd like to see if it holds here and instead of continuing lower, starts to build a base. If it does, I'll consider it for a trade, but not doing anything long-term here. We'll go ahead and take a look at a few more here. I haven't covered EOS in a while, as I haven't been really talking too much about individual altcoins. EOS, I like how, like a few other altcoins out there, they're starting to make higher lows. And because of that, it's starting to build a base where, again, risk-taking can possibly come in once people see that higher lows are coming in. Larger institutions start to build positions. This tends to happen in most markets. So I'm keeping an eye on it, but before I really did any trading, I not only like it to get past this level of resistance, but that would also get it above the 100-day, giving it a lot of room to hopefully test back up towards the 200-day. So keep an eye on that as well for a trade, or potentially to see some moves in the market. Going on, let's go ahead and take a look at a few protocols. I know I've been kind of skipping out on this, so I'll do a little bit of TA analysis. For some of you, I know some of you are big fans of Cardano. Cardano, it's very similar to Ethereum here. I'd like to see this come back up to the previous highs here. And the reason I say that is because if we can get it back up here and again, a momentous move up that kind of cups up the price action here towards the previous resistance that we saw over here and over here, I think that's going to be a good sign again to possibly test up towards the next moving average. Once you get past the 50-day, usually test up towards the higher moving averages. We see this with a lot of altcoins. Going on with Icon. Icon has definitely kind of gathered a little bit of my interest. We've gotten through this wedge here, and we're testing up. We've done exactly what I was talking about, the cup up of price action towards where the drop-off was, and if we can get that and above the 100-day, you've got a big gap to fill between that and the 200-day. More than, of course, the 200-day will continue to deplete, but we might have a big gap to potentially fill there still if we get above the 100-day here in the next few days, and if altcoins in general start to make higher moves. So keeping an eye on Icon there. But the one that I got to say, it's really interesting to me here is Verge. Let me go ahead and get Verge on the proper exchange again. Just like Ripple and Tron, it's a momentum play. Whether you like the project or not, it's a momentum play as a trader. And what I really like is that if we take a look here, we are building a higher set of lows 3 times already. It's very, very clear that a base uptrend is starting to form here. So, again, even if you wanted to trade it up to this level that has been the sell point here at 260 Satoshis, about a 40-cent profit. It's pretty decent here if you guys wanted to take that risk. But again, still relatively low volume for Verge in the past, even for Binance here. So I would say to do it cautiously and set up a proper trade setup. But I'm not recommending it, just letting you guys know this is something that I'm watching at the moment. I've done a few little swing trades on Verge at this bottom area. Done quite well, but I've had like about 2 or 3 winning trades, 1 losing, 1. My wins outweigh my losses, so that's good. So let's go on here to talk about really the big headline here. As we discussed earlier, this is really the thing that in a very kind of quiet, boring market that everyone's got their eye on. Why is there a $300 premium on Bitfinex? Now, as I mentioned earlier, there's some reasoning. Some people have kind of compared. They've compared the idea that people are still worried that there's no proper banking solution for Bitfinex, so maybe that Bitfinex is insolvent, or that Tether itself really doesn't have the pegged 1-to-1 ratio, and that people are just starting to realize it and might be worried and are swapping out to Bitcoin here. There's a really interesting quote here. I'll go ahead and show the visualization here for you guys who haven't really seen it. This is the difference between Bitfinex and I would say probably, I don't know what the other exchange is here, but I would assume something like Coinbase. Most exchanges are generally on the same page around this range, and it has about that $300 premium. Not to mention we saw the dip off of Tether the other day from its $1 peg. This is a quote here that I want to use to kind of summarize my point on this, guys. So there's a person named Alex Michaelis. I might be saying the name wrong. I apologize. Terrible names. But they're a researcher at a company called CoinSchedule, and they recently got to visit the Bitfinex office and stated, I don't think Bitfinex is going under. We've met with them last week, and that is not the impression we got. Michaela said it in the email. What I think happened is that a lot of people think Tether is going bust, so they're exchanging their Tether for Bitcoin and pushing the price up on those exchanges. Now, whether this is true or not is kind of arbitrary at this point. No one has any idea. We've had people, for example, make claims like this who visit companies, and it turns out they actually are completely solvent and okay. And then you've got people who had defended exchanges like Mt. Gox or Mt. Gox in the previous case of Bitcoin that have been insolvent and have been hacked. And Bitfinex has a history of that as well, getting hacked as well in the past. And they handled it in a sort of good way and a sort of bad way. I recommend you look into the past of Bitfinex's previous hack and some of the criticism they got for handling it. But nonetheless, here's the point I'm going to make, guys. It's the reason that I have not touched Tether. And if I were to touch Tether, it would be for a short-term trade, because it's just like how people make the argument that not your keys, not your crypto in regards to having your money on an exchange. It's the same exact argument for saying if you're not in Bitcoin or you're not in your altcoins, it's not your crypto in that sense. Like you own Tether, but there is a very big concern about the solvency of Tether, the pegged 1-to-1 ratio. So this is a big point that I try to drill in here. If you're going to use Tether, I'm not going to make any recommendations. I'll let you know how I use it. I use it on a very short-term basis if I've ever used it in the past. And I would prefer, in my personal opinion, use something like TrueUSD or some of the new stablecoins coming out. I think a lot of people are making the switch as well. But the thing that's got me concerned is that the premium has held for so long. That is not natural. That's not just people getting a little bit worried and switching to Tether, from Tether to Bitcoin. Something's going on here, and I don't know if it's as severe as some people are making it out to be, but I'm not going to take that risk. All right, I'm already taking enough risk being exposed in altcoins and cryptocurrencies in general. I love this space, and I'm willing to take that risk because I believe in it, but I'm not going to be in something like Tether at the moment. Alrighty, so that's it for crypto markets. Let's go ahead and talk about some really interesting indicators going on in traditional markets. I want to spend some time to really talk about a key indicator here and jump into some of the key indicators on equity markets. There is a headline here on Zero Hedge talking about the dollar LIBOR jumping to fresh 10-year highs, adding to funding headwinds. So we've talked about the LIBOR rates in the past, and we're also going to be talking about some key charts here to kind of indicate how there's been some sentiment change really just over the past month, and it looks like we're heading back towards more of those February levels of fears. But LIBOR rates is basically, it's an interbank lending rate. So we're basically, it's either, I might be mixing this up, it might be London-based banks or European-based banks, but basically the LIBOR rate is the cost of capital or the interest rate that banks charge one another. And they have a few different LIBOR rates here. You've got the 1 month, the 3 month, the 6 month, 12 month. To put it simple, if we're to take the 12-month LIBOR rate here, it's the cost that a bank is going to charge another bank to borrow capital for 12 months. So we can see over time that the rates tend to rise and they fall because of differences in the economy, differences in the rates of central banks, which is the first initial rate you're gonna have to incur to borrow capital, and then you have obviously borrowing from other banks, which again they need to make a profit on the original money that they're borrowing. That's higher than the interest rate they're paying. Again, this is why debt cannot be paid back on the grand scheme of things. So there's always going to be someone left without being able to make payments. Anyways. LIBOR rates have been going up over the past few years. Really, ever since 2015, we've started to pick up an uptrend from the years of 0% interest rates from central banks. And now, since there has been talks of not only raising rates across the board, but also the U.S. raising rates quite dramatically, LIBOR rates have gone up. And this means that the cost to borrow capital is going up. And it just made a fresh high for the past few years, ever since we've really escaped the years of 0% interest rates. But the thing I really want to bring up here is a chart here that is a really interesting indicator that became an indicator to determine fear or the market being on edge. And that is the FRA-OIS ratio. Now this is, I'm going to probably mix up the acronyms here. They're very fancy terms, but generally speaking, the FRA is deterministic of something that's more of a generally kind of the market rate that you're going to be paying for interest in this case. So a good example would be the equivalent of the LIBOR rate. In this case, I think you can generally determine that the FRA is the LIBOR rate in this case, comparative to the open index swap. Or the it's open index swap, yes. Again, I might be mixing up my acronyms. But basically, to get rid of the fancy terminology, guys, just to put it simple, I like to do that. Basically, it's the ratio between what people are paying in regards to the LIBOR rate, the basis point difference. So it's a percentage difference between the LIBOR rate and what the federal funds rate is, the interest rate that things like the central bank, like the Federal Reserve, charge. So if there's a bigger spread between the open market rate to borrow capital between banks and that of central banks, it shows that there's a little bit of hawkishness or bearishness in the market. The market is on edge, that they're making it more expensive to borrow capital. And we can see here that we've had almost practically, really actually about a 50%, more than 50% increase from September to October within 1 month in regards to the divergence between the LIBOR rate, as rates like the LIBOR rate, as well as the rates that central banks are charging. So again, we're seeing something very similar to what we saw back here in January, February, and March, where the difference between these two rates are going up. And as we all know, equities were selling off quite dramatically back in February. So this is, again, seen as an indicator. The cost to borrow capital in the open market between banks tends to go up when we have fear in the market. So again, a fresh high since what we've seen back in July as we were on a downtrend here. So things to keep an eye on here. It's these kind of indicators, guys. I hate to be like the mainstream media doesn't want you to know about this. Like, they just won't tell you things like this. You won't hear about this on a lot of mainstream media outlets. But these are indicators that people use to assess risk. And I think it's one of many indicators. And just generally looking at the increase in the LIBOR rate, is an indicator that we can utilize to determine the risk of markets being set up for recession. Now, why is that? Very simply put, taking away all the complexity with comparing the open index swap and all that kind of stuff, we can see here that when there's dramatic rises in the LIBOR rate, sometimes they are followed by dramatic declines. And these gray areas on this chart, these gray rectangles across the chart here going downwards in a vertical manner, these are recession periods. And we see that after the rise in interest rates, or a dramatic rise in interest rates, it takes about 6 months for an economy to feel the pain of higher interest rates. And then obviously you make the response is always too late. The results have come in, the economy has started to take a hit, and then you have to dramatically lower interest rates. This is the case every single time as we've been declining. So now as we're starting to rise rates here at a pretty rapid rate, and to really put it in perspective, which the 12-month rate just back a few months ago was 0.6%, roughly speaking, or about 0.6% here. And now we're towards about 3%. That means that the cost for a bank to borrow money for 12 months between another bank is about 6 times higher. Excuse me, no, let me do my math right. 5 times higher than what it was back in 2015, just 3 years ago. So put that in perspective there. It means that banks are going to either A, need to make sure that the money they're borrowing they can utilize to make more money on equities markets by investing and propping up assets as they've been doing for the past 10 years, or that they're going to have to increase the interest payments of the money they're lending out. So the consumers are going to pay higher interest rates. It always gets passed on to consumers in that case. When the rates go up, the banks are going to make sure to guarantee the profit margins. That means that you as a consumer borrowing capital or debt, in this case from a bank, are going to have to pay a higher interest rate. Higher interest rates, a lot of people can't pay those higher interest rates, meaning that the economy goes into a recession. People stop borrowing, capital stops flowing, credit, more predominantly credit stops flowing in the economy. So a little bit of a lesson today. I know I rambled on, but again, keep an eye on some of these indicators, guys. Learn a little bit more about the kind of macro picture. I find it fascinating. If you guys don't find it interesting, don't worry. I'm sorry to bore you. And maybe in the future, I'll tell you can skip a few minutes ahead and stuff. But I like talking about it. I think you guys like getting that bigger picture stuff. Anyways, let's go ahead and talk about equities here. So we're taking a look at the Nasdaq Composite here. The picture across the board is relatively similar. I'll just go ahead and jump through here. We can see it's the same kind of pattern. Quite a decent rebound here off of the 200-day. Some were closing below the 200-day, but we've gotten back above the 100-day. Some of the indexes are below the 100-day. Again, we can see in the S&P 500 as well, still below the 100-day here. Generally the same price patterns across the board. Now, a lot of people would say that this is a steady rebound here, and that the markets are getting optimistic, and that, again, we're playing the same trade we have in the past, where a dramatic sell-off comes, dramatic rebound comes in. Again, BTFD, but I'll keep it nice and just say buy the dip. But basically, that's the trade that I think a lot of people are thinking to play here. Now, I would have probably said that in the past when we held the 200-day quite steadily, and we had a nice rebound off of it, because I know, again, buybacks are still flowing. We're out of the buyback blackout period. And along with that as well, U.S. equities are still looking strong as comparative to other markets. But here's the thing I'm going to say, guys. Go ahead here to the Nasdaq, as we were looking at originally. Take a look at the monthly, okay? As a trader, I'm on edge as I was in 2015. I remember this moment when markets were dropping quite quickly. And when you have these kind of flash crashes where equities drop quite dramatically and cut out months worth of price action, you have to be a little bit on edge. As much as you might be looking for a trading opportunity or to buy the dip, as many people do, you want to be cautious and on edge. If you're going to try to do that, make sure you set proper stops. Not too tight, not too extended to where you're going to be losing more than you want. Play it right if you're going to do this. But I would say that for those of you who are kind of on edge, is this the next recession? Are we setting up for it? Well, there's a lot of indicators across the board, and this is why in 2018 I've been fearful on equities across the board globally. The reason I say that is because we can take a look at some major indexes. For example, the Home Builders Index. This is coming back down to the 200 month here. We have not seen this dramatic of a continuous this continuous of a dramatic sell-off in the home builders since back in the years of 2008. Okay, That's a very worrying sign here in regards to a percentage drop in home builders. And it shows that the housing market is losing a lot of optimism. Sales have stagnated to a decent degree in a lot of the major cities. Prices are relatively stagnant. They're still holding a lot of their high levels. But if you get another few months where there's not enough demand and people can't afford the prices, the market corrects. It meets to meet with the prices that consumers are willing to pay. And along with it as well, one index that a lot of people don't look at is the small cap index. And this is the Russell 2000. And I got to tell you guys, looking at what we saw back in 2015 to 2016, where we saw the Russell drop from 1,300 down to 950, I think we're going to probably see a much more continued drop here in small caps, where risk turns from risk on to risk off. So the market is going to be stepping away from the riskier plays. And I think you could see one of two things. You're going to see the Russell probably come down towards this more long-term uptrend here, which has tended to be the point of resistance in the past. It might become support here around 1,300 points. Again, finding support on previous resistance. Or in the grander scheme of things, you're going to see not only the Russell can collapse down to probably down towards 850, which would be about a 50% retracement, but I think you're going to see, if that happens, you're going to see the entire market come down. So you're going to see the Nasdaq probably come down, build support around here at 5,000. You can see the S&P 500 come down to maybe more of a level such as down here around 1,600 points. Again, a little bit less than a 50% correction, but still holding the majority of the gains here for equity markets. And this is something that's going to take a much, much longer time period. I don't think it's going to be a flash crash where you'll see the stocks drop tomorrow. U.S. equities, again, like I said, look to be the strongest out of all equities right now. So I wouldn't really try to bet too seriously against U.S. equities. So my point is here, if you're going to play a bullish play here, play it safely and know what you're going to look for to get out of your position and take an opposite tone, or just remain neutral in cash in the market. All right, so I want to go ahead here and talk about commodities. We'll run through commodities here. Gold, very interesting right here. Currently getting resistance at the 100-day after its big leap upwards, looking to potentially try to break out above it. I would keep an eye on this here because what we're seeing right now is some of the largest purchases from central banks across the world. The central bank net cumulative purchases in tons is the highest level it has been over the past few years here in 2018. I'll go ahead and expand the chart here a little bit. We can see that really after towards May, we can start to see that we're really outpacing the growth of purchases for central banks in gold. And this is going for really commodities across the board. I think central banks are preparing with higher rates. You tend to find this in regards to kind of hedging as a security measure, especially a lot of these emerging markets that are going through big crises, not being able to pay back the U.S. dollar denominated debt that is denominated in the dollar. And as their currency is depreciating, I'll talk about this in a future video. I'm working on a big piece right now. They're not able to pay this, and that's what's causing a lot of the currency crises, such as Turkey and Argentina and a lot of other countries out there. But anyways, that builds a very big demand for something stable that stores value like gold, and also may increase comparative to inflation over time if, again, people are swarming in to get this store of value, as we can see with things like Bitcoin, for example. Over time, they have these parabolic run-ups, just like how Bitcoin does. Now, the one thing I'm really interested in here out of the two plays here is silver. I've told you guys the gold-silver ratio is making silver an optimal play comparative to gold, in my opinion. And along with that, I like how this is holding on the 50-day. We still got some range to come up to the 100-day here, as well as the 200. So I'm going to be looking to potentially do a trade on this personally. I'll probably do a little bit of leverage on it as well, just to increase the potential reward in this case. But I would set a tight stop for this breaking below the 50-day, at least in my strategy. Going on to our last topic here, uranium. A lot of people have asked me about, do I still have uranium fever, Nick? Yes, I do. To put it simple, guys, I'm waiting this, however, for it to come back down towards the lows and test this support one more time. If it does that, we're getting towards the narrow end of the wedge, guys. I think with commodities coming up, if equities start to make a correction, commodities will most likely probably be the play. And with that, we could start to see uranium make a serious move after this more than 2 year bottom, after a multi-year decline from obviously the commodities collapse back in 2008, as well as the incidents in regards to Japan with the nuclear reactors. So again, could be a major shift with spot price increasing, equities holding nicely. could be an interesting play. But anyways, that's it for the video. I know I gave you guys an absolute mouthful of information. I'd like to know what you guys think about this, though, in the comments down below. What do you guys think about commodities markets, equities, cryptocurrencies? What do you think about the Bitfinex spread? What's going on there? I'm interested to really just get as many opinions, because I think we're all kind of lost for words. I'd let you guys know if I knew what was up, but sadly, it's just something that's still up in the air. But anyways, that's enough rambling for today. Thank you for spending some time listening to me ramble, and I hope you guys have a wonderful rest of the day. And until the next video, I'll see you all in the next one. Stay tuned.